Good morning and welcome to the US Securities Markets Update. Beginning with the US economic releases yesterday, the data came in with a mixed outcome. However, the broader USD buying continues or remained since the beginning of the week, and this is mostly dependent on two factors. The first one is basically declining oil prices, and the second one that many Fed members hinted for a rate hike in September, even after the weakness that we saw in wages during the second quarter of this year. As widely expected, the core PCE price index also increased by 0.1%, while the year-over-year remained stable at 1.3% in June after revising May's reading from 1.2%. The personal income also increased by 0.4% in June, which is also the same rate of increase that we saw last month. However, the personal spending showed the weakest increase in over 4 months, rising by 0.2% only in June, and May's reading has been even revised lower towards 0.7% instead of the 0.9% reported also previously. The ISM manufacturing PMI also was released an hour and 30 minutes before its schedule, unexpectedly declining back to 52.7 in July, down from 53.5 in June, despite the fact that it had been anticipated to rise or to remain stable with no change. Finally, the construction spending, or before going to construction spendings, we had also the ISM manufacturing employment component, which also declined back sharply from almost 56 to back to 52.7, which is the lowest level since May, or in over 3 months. The construction spending was the most disappointing yesterday, rising by only 0.1%, while it had been anticipated to rise by at least of 0.6%. And the good news was that May's reading has been revised higher toward 1.8 instead of 0.8%. Looking at some commodities today, oil prices also tumbled yesterday. Brent crude also lost more than 4.5%. Trading around 49.2, and also the West Texas crude lost more than 3.8%, reaching as low as 45.11. And this is also occurs on the back of the Chinese manufacturing data, in addition to the rise in OPEC production to a new all-time high, and finally the fears from the upcoming Iranian supplies, which will start flowing once the sanctions are lifted, which might be at the end of this year. But however, the continuous decline is an evidence of a deflationary environment, along with also the movement occurring with these commodities. In addition to that, or the central banks may continue or may be forced to intervene again. However, it's still very early to judge. Looking at some technicals today, the Brent crude, after breaking below the support area in the past few days, there is no decent support before 47.78 and also 45.19. And as for West Texas crude, yesterday we had also a break below 47.05, which also clears the way for further decline, and there is no decent support before 42.03. This is on the daily chart, which basically we're talking about short-term to medium-term trading. The S&P credit rating agency came in yesterday after the European closing bell with a disappointing announcement cutting the EU, or the European Union, outlook from stable to negative. Moreover, it revised the foreign currency outlook from stable to negative, again affirming the AA or AA plus rating. And yesterday's rally in European equities could face its sell-off today following the decision. The US equities also began the day higher yesterday after the US economic releases. However, the rally has faded just few hours. The Dow Jones also lost around 0.9%, and the S&P is basically lost more than 0.6%. The Dow Jones basically tested its another major support area, which stands at 17,515. The S&P 500 also already traded below, but however, before going into S&P, the Dow Jones continued or tried to break below that support, but so far it remains well above that support, which basically could be a potential triple bottom. However, at the same time, we still need to watch this level very carefully. The S&P 500 also started the day well below its 50 and 100-day moving average, in addition to trading below its 2088 support area. However, this continued also to keep on supporting the index and continue to rise again. Moreover, gold oil ratio also advanced to the highest level since March reading, which basically around the 2090s, which suggests another sell-off in the US equities, especially the S&P 500 in the coming days, which might continue to trade toward or below at least a 2080, and might continue to decline further toward also 2069, which represents its 200-day moving average in the yellow line. During the Asian session, there were also few economic releases and events which had a notable impact, especially on the Aussie. The trade balance deficit widened slightly less than expected in 2 months, almost or to 2-month lows, toward minus 2.93 billion in June compared to minus 2.68 billion, while the estimates were to rise again or to widen again toward 3.06 billion. Moreover, the retail sales increased by most since February, rising by 0.7% in June after 0.4% in May, while it had been anticipated to rise by 0.5%. The Reserve Bank of Australia left the cash rate on hold earlier this morning at 2%, while the bank showed a balanced statement with no dovish tone, leading the Aussie again to rise across the board. The Aussie against the dollar also spiked by more than 0.8%, reaching as high as 73.60s, up from 72.70s. As for the European session ahead, also few economic figures will be released from Spain and the UK. The Spanish unemployment change and the UK also construction PMI are both set for or to deliver positive readings. During the US session, finally, we wait for two releases only, including the factory orders, which may rise by 1.8% last month and after declining by 1%, and finally the GDT or the Global Direct Trade Price Index in or from New Zealand will be released throughout the day. Finally, we'll just point out something about our favorite pair, which basically the pound against the dollar. So far, the tight range continues between 155.50s and 1.56, with no indication of a clear breakout above or below that level. However, today's construction PMI might be the catalyst, and our positive outlook remains as long as the pair continues to trade above 1.55, but at the same time, a break above 1.5670s is still needed to clear the way for further gains above 1.57. This is it for today. You can follow us on our social media sites, Twitter, Facebook, and YouTube to get the latest economic releases, reports, and analysis. Thank you for watching. I'll see you once again tomorrow.